Okay, good morning, everyone, and welcome to our Tuesday Market Outlook session. Today, I'll be walking you through how we are viewing the current market. So we saw a fairly sizable decline on Friday over fears of the new Omicron variant. And the question really is, how badly is this new variant going to impact equities leading to the year end? Over the last number of weeks, equities have been resilient and we're looking quite strong heading into the festive season. But now we have a new unknown variable in the mix. And today, what I would like to do is to go over the key levels that you should be made aware of and to give you a better idea of how we are viewing the markets and the possible scenarios that the new variant brings. So as usual, quite a lot to get through today. But before we get started, just a quick disclaimer. The types of securities, forms, and research tools used in this video are for demonstration purposes only and should not be considered a recommendation by OptionsPlay or a solicitation or an offer to buy or sell any securities. This video is not intended to be used for individual tax, legal, or investment planning advice. Okay, our agenda for today, as usual, we'll be starting off with the major indices. We'll be highlighting some key levels, going over some technicals to get a better idea of market direction. And should markets decline, where will they decline to? There are some unknowns right now, and it's always good to know what the options are to be prepared for different scenarios. From there, we'll be moving on to fixed income and commodities, and we'll be taking a look where they're currently trading at and what levels to look out for. We'll be discussing sector rotation, and we've seen a lot of sector rotation here. Definitely some narrowing leadership. I think it's quite important to go over that today. And we'll end today's session with some subsectors of interest and some bullish and bearish market observations. My name is Prakash Vijayanath. I am an analyst here at OptionsPlay, and I'm really excited to share with you our thoughts and analysis on the current markets. So, starting off with the S&P 500, we saw a bit of a knee-jerk reaction on Friday, as investors were definitely spooked about the new variant, and price did recover yesterday, and I do view that as a positive in the short term. However, I do see from the last time I checked that the S&P 500 will likely gap lower this morning. But that being said, we have to remember that we don't know much about this new variant, and the main question is whether it will have a big impact to this ongoing global recovery that we're experiencing. We're also seeing a bit of a bifurcation, if I could use a word, in relation to the responses between the US and Europe, where Europe, even before the new variant was in play, Europe was starting forms of lockdowns to combat its surging Delta wave. The US will likely not impose new restrictions, which is a positive for equities and provides a bit of a defense against a possible slowdown in global demand. And if we take a look at the chart itself, we can see here, definitely looks like price is going to be gapping lower this morning. We saw a bit of that knee-jerk reaction I was talking about, a slight pop-up on Monday, a bit of a recovery. I think investors realize we don't know enough to know this is bad news, but it does provide uncertainty, which is never good news. And what I'm seeing here with the S&P 500 is obviously the strong bullish trend, maybe to a bit of an overbought condition. And I do think that the price action at current levels is indicative of a move back down here to 453. That will be the first support level I'd be looking at. That being said, if they come out and say, look, our vaccines are completely ineffective against this new variant, I would not be surprised to see this level broken. And that's because that opens the door for governments to use harsher lockdowns. And especially, you have to consider the timing of this. This is during the festive period where companies are very much reliant on high consumer spending to take them through January and February when we see a bit of a pullback in consumer spending. So the timing isn't great. And I do think that should we find out that this variant needs a new vaccine that will take months to develop, I wouldn't be surprised if that's a catalyst that does break the support level here at 453. And the next real major support level that I would consider would be 428. And maybe also look at just below 440 or so, a bit more of a minor support level there. But for the short term, definitely a change in sentiment for equities, shifting more towards neutral from bullish. But we may see a bit more choppy price action until we figure out more about what we are dealing with. So moving on to the NASDAQ 100. In my opinion, in the worst case scenario, should we need a new vaccine, the NASDAQ 100 does provide a better defense against the S&P, as it is more focused on the technology sector, which we saw had a strong outperformance in the first few months. So can everyone hear me okay? I think I just got someone in the chat saying the audio was breaking up. Could you just type a one again? I apologize if there was something wrong with my mic. Okay, I apologize for that. I think we can continue. So, as I was saying, the NASDAQ 100 is more focused on the technology sector. We saw stronger outperformance in the first few months of the pandemic, and was really the only sector that provided leadership in 2020, the technology sector. And in the worst case scenario, where the vaccine proves to be ineffective against the Omicron variant and governments impose harsher lockdowns, we may see a similar reaction to the early months of the pandemic, where the NASDAQ outperformed the S&P. But that being said, I do think there's still some potential downside here for the NASDAQ 100. The key level here, initial key level, would be 390. Price actually did find some support over the last 2 days there. But should there be more downside, this level should be broken and probably a move back down to 382. Worst case scenario, if that level's broken, I'd probably be looking at around 370 or so. So significant declines here, possible declines here ahead in the worst case scenario. But again, if you take a look at how strong this rally has been, I really wouldn't be surprised if there was a pullback here for the NASDAQ 100 before. But I do think it does provide a better defense against the S&P 500 and will, even when declining, outperform the S&P 500 during this period, especially when we see leadership starting to narrow. And we will get into the sector rotation in a few minutes or so. And this leads me to my next chart here, which is growth versus value. I spoke about this ratio chart 4 weeks ago. I actually mentioned it last week as well, but I mentioned that this is going to be a chart where we'll be looking at more often heading into December and January. And back then, I believed that the headwinds that equities were facing would have a bigger impact on Q4 earnings. But what we're seeing here is strong performance from growth. And again, it reminds me of the time it was back to the early days or early months of the pandemic where we saw that strong outperformance. You actually can't see it very clearly here, but it was a strong outperformance here for growth relative to value. And we may be starting to enter that stage again in the worst case scenarios. So I think this ratio chart is going to be one that I'll be referring to more often. And it's one to pay attention to because we want to see, if we see growth outperform value, that's even more of an indication that it's the technology stocks that are providing leadership. So looking at the SPX Equal Weighted Index, this for me is very concerning because we are already seeing that underperformance of the S&P Equal Weighted Index relative to the normal S&P 500. And straight away, this is an indication of narrowing participation that we saw in the early days of the pandemic. So I am drawing a lot from the early days of the pandemic because that was when we didn't have a vaccine. And it wasn't really until we received news about a vaccine at the end of 2020 that we saw that broadening participation in the equity rally, that we saw the other sectors start to participate in the strong equity rally that we've experienced in the last almost 2 years now. So again, in the worst case scenario of not having an effective vaccine against a new variant, it's similar to the early months of the pandemic. But even then, I don't believe it'll have as big of an impact as we saw in Feb and March 2020, as there's a few things to consider, right? One, companies are better equipped to handle lockdowns. They've invested a lot more into reshoring and a lot more into developing an online presence. Secondly, this if the Omicron variant really negatively impacts the global recovery, the Fed will likely be less hawkish, and that is usually a tailwind for equities. So while there could be a significant decline, in the worst case, I do not believe it'll be anywhere near the magnitude of early 2020. But again, this chart tells me narrowing participation already, and it just reminds me again of the earlier days of the pandemic where we saw the same narrowing participation. So moving on to bonds, price action here has been, it's been choppy. It's been tough to really predict bonds right now. There's so much fundamentals that are just, and so much news that's coming in on a day-to-day basis. But we saw the strong reaction on Friday, a massive gap up. And we know that 151 level has played a strong resistance level. It's bounced off that level almost 5 times really. But it looks like price is going to open up near that level. And I do think it has enough momentum to actually break above this level as investors flock to safer assets and maybe a little bit out of equities. But again, it comes down to when we know more about this variant and how effective our current vaccines are. And I do know apparently someone in Moderna was saying that we may need a new vaccine earlier today. So far, not great news, and markets have reacted quite negatively to that, especially equities. But we have seen that gap up here in bonds as well. So one thing to watch here would be a break above 151 and a continuation higher. Next key level here for TLT, should a break above that level, would be at around 155 or so if we take a look at the weekly chart. Taking a look at yields, again, big decline here in yields. If obviously with everything going on, it may mean a less hawkish Fed as well. So at the end of the day, we can see here yields have not responded well. They've actually declined quite a bit, and which isn't a bad thing for equities as a whole. Maybe bad for financial stocks, but it does look like to me yields, there's more downside here all the way back to 137 basis points or so. Should that level break, which I'm not sure if it really will, the next support would be around 115 basis points or so. So if we take a look at the dollar index, we saw, the strong rally from May all the way to last week at around where price rallied from 89.5 to nearly 97. And the possibility of a less hawkish Fed will naturally drive the dollar lower, but you have to remember that that its value is based against a basket of other currencies, with the euro having the highest weighting. So I do think that a pullback is on the cards, but I do think it'll be a temporary pullback, especially when you consider the fact that Europe are in no position to raise rates anytime soon compared to the US, and the euro is fairly weak at the moment. So I do expect, a little bit of a pullback. Price was definitely overbought, as you can see here, with long-term momentum above the 200 level. And it was really diverging away from its moving averages. But overall, the outlook remains bullish on the dollar. And we may see a pullback. I think the first level to really look at would be this one, which found support a few days ago, but the 94.5 level as well. I expect that the dollar will find a strong level of support there. Taking a look at crude, and we have seen a complete shift in sentiment here. Strong rally all the way to 84 or so, and complete reversal all the way back down to 67, where price has found support in the past. But again, fundamentals here are key for crude, and the fact that more countries are going into a lockdown means that there's less demand here for oil. So even if OPEC decides to cut supply a bit more, I actually do think there's more downside here for crude. Should this level break, I think the next level to be looking at would be the 62 level here or so. And we've seen the drop in crude here really impact energy stocks. So again, we'll take a look at sector rotation soon. But one to look out for was this break below the 66.5 and further decline all the way to 62, which is another major support level. So moving on to the sectors. Last week, as you can see, 10 out of the 11 sectors all had bullish trends, with the exception of communications, which has been, fairly bearish. for a while, and I've maintained my bearish stance on communications. This week, however, we're starting to see that weakening, not across the board, but just a few signs of it. Financials on the back of lower yields are weakening. Energy on the back of lower oil prices are weakening. And I mean, other sectors are still maintaining their bullish trend. We are seeing overall a little bit of weakening here when you look at the fact that now there's only 8 out of the 11 that are on bullish trends compared to 10 out of the 11 last week. And we take a look at the sector rotation chart. Again, only 4 sectors now in the improving and leading categories, 7 in the lagging and weakening. And again, technology here providing leadership. It's the only sector in the leading category, but we are seeing utilities improving in momentum and relative strength, and it may rotate into the leading category, and staples as well, which are traditionally the more defensive sectors in times of uncertainty. Utilities, staples, and usually healthcare as well tend to provide a bit of a defense for equities. We're seeing strong rotation here in materials out of the leading category into the weakening category, and it's looking like it'll be joining the lagging category soon. Financials and communications have seen a bit of a reversal here in momentum. Communications did have initially a strong rebound in the last 2 weeks in terms of momentum, but it hasn't been able to maintain that and hasn't been able to turn that into leadership. So we are seeing that reversal here back into the lagging category for communications and financials, as well as industrials as well, which was looking like it was heading into the leading category a couple of weeks ago. So taking a look at some sectors, I wanted to go over utilities here because even though it was showing strong momentum relative to the broader market, here's where I'm still not 100% convinced about utilities. First thing you see here is this resistance level at around 68. Price has rejected that in the last few days a couple of times and is now retesting that level. That being said, if you take a look at this chart, first thing, head and shoulders, right? You see the left shoulder, the head here, and the right shoulder here. So for this to be invalidated, this is a bearish setup, right? Because normally what happens here is the head and shoulders pattern is that price moves lower here. You look for a trend, the neckline break, and that would really confirm the completion of a head and shoulders pattern and a continuation lower. But that being said, we have to take momentum into account here. Momentum is positive. We saw that yesterday it had a strong bullish price action. And again, but you really want to see a break above the 67, 68 level for that confirmation for a move higher here back to 70 or so. So one to keep an eye on, utilities. Discretionary, strong outperformer, but I do have a bit more of a contrarian view here for discretionary. I think that there's high risks associated for the retailers coming into the year end, early Jan, and especially Q4 earnings, where we see the strong outperformance, right? We saw the fact that there was evidence that that inflation, the high cost of inflation, were being passed down to the consumer. One, that isn't something that's sustainable. So while we did see that, and while that did provide some short-term fuel for discretionary, that's not sustainable. But my concern here is, in the worst-case scenario, can discretionary maintain its current levels? Should there be, many countries that impose lockdowns during the festive season? And we know how important the festive season is for a lot of retailing names. And I don't really think it can. I think we're in for more choppy price action at current levels. And the key levels to really take a look at here would be the 201 support level, where price did find support earlier. And should price break below that level, it really does open the door back down to 191 or so, which, I mean, was more of a really weak support level. But I don't know, it's hard to say if it will decline that far. But I do think it's primed for a bit more of a pullback here. Taking a look at technology. So again, the strongest sector at the moment. We saw strong rally here all the way to around 174, 175, and a bit of a pullback all the way back to its 21-day exponential moving average. And we're seeing a bit of a rebound here for technology. I do expect this to continue, whether despite fundamentals playing a part, because at the end of the day, in the worst case scenario, we will see rotation back into technology. And in the best case scenario, I just think it'll be, and in the best case scenario being that the vaccines do work against the new variant, and there's evidence of that, I still think that this rally in technology will improve. And especially when you take a look at the semiconductors, which obviously play a big part in the tech sector, we're seeing that strong outperformance here all the way to 320 in the last few weeks, a pullback again to its 21-day exponential moving average, and a strong bounce higher here. So even before the new variant, semis were looking good, technology was looking good, and I do think we can expect a continuation here for both technology and semiconductors here. And the SMH semiconductor ETF, I think, provides a great broad-based exposure to semiconductor stocks, which can be quite volatile and quite cyclical in nature. So one to keep an eye on, definitely. Taking a look at biotech. So I was fairly bearish on biotech, and it really did look like price was going to decline all the way here to 145. But obviously, what happened on Friday, we saw a bit of a resurgence here for biotech. We know that they'll get more funding as well, especially if there is a new variant, if there's more vaccines that need to be researched, and we can see that it did find some support here based on Friday's news. That being said, price action hasn't been very bullish. It did run into some resistance here at 158. And I do expect a bit more choppy price action here until we find out more information about this new variant. And should this level break below again, and should it be the case that the current vaccines will work against the new variant, I do expect that continuation lower back to 145 or so. So taking a look at some market observations. Firstly, I'd like to start off with taking a look at T2 Interactive Software. A strong, very strong rally, all the way from 144 to 196. And then despite beating on earnings, it still pulled back quite significantly all the way to 164. And we are seeing some bullish price action here. And I will say, I'm not 100% convinced for T2 unless it breaks above the 169, 170 level, and preferably above its moving averages here. From there, I think I'll be more comfortable with looking at T2 as an option for a move back here to 188 or so, because its fundamentals look good. Demand in its products still remains robust, and I do think that it has a potential here, especially after this significant pullback. It provides a very good risk to reward move higher. Taking a look at Zscaler, again, we've seen a very similar setup with the strong rally all the way near to 380, and a pullback to its 21-day exponential moving average, and a bounce higher. And cybersecurity as a whole, it's been very strong since the start of the pandemic, because companies are investing more into their online presence, and they are going to be investing more into cybersecurity. And we're seeing Zscaler really benefit from that. What we can see here is almost a textbook pullback and bounce, strong momentum, and overall the technicals do look good for another leg higher here for Zscaler. Then taking a look at Moderna. So you can't really ignore Moderna right now. More of a speculative name right now for sure, simply due to its volatility. What we saw here, if we take a look at the charts and we take a look at the price action, was a bit of a consolidation period at around that 450, 360 level. And then price did break below that level with strong bearish momentum. It came back to retest it and move lower. And in recent days, there was a bit of a pickup here. And we saw, based on Friday's news, a gap up all the way back, which helped it move back up the 360 support level, or previous resistance level turned support. Intraday yesterday, price did pull back to that level and bounce to end the day a little bit higher. But I do think there's more upside here for Moderna, especially with the whole new variant. And I do think that, if it comes into play that more vaccines are needed, there's definitely more upside here for Moderna. But again, more of a speculative bet. Yeah. Taking a look at some bearish market observations. First one, American Airlines. This is a long-haul carrier, so these are going to be more affected by the travel restrictions imposed by the rest of the world. And we can see that here. We can see a strong break below that 1888 support level, and it looks like price action is telling me that there's room for a further move lower here, all the way to the next support level at around 15 or so. And you really have to take a look at the weekly chart to get a better view of that. So strong break below support, momentum, long-term and short-term momentum remains bearish. And I do think the fundamentals are just not favoring airlines at the moment. I do think there's more room for more downside here, especially when you want to look at the longer haul carriers as opposed to the likes of Southwest Airlines that are more domestic. Taking a look at Discover Financial Services, I mentioned DFS. I mentioned them as a bearish market observation, I think 2 weeks ago, where price is trading at around 120. We saw a bounce from the 113 support level, a rally back to 120, and a strong move back down again all the way to 113. Now, this is a key support level, but weak momentum and bearish price action here does indicate that a break of the support level is on the cards. And I think should that level be broken, possible targets would be 104. This provided resistance a few months back, where price did form a double top before breaking above. And should that level be broken, or I do think that price has a potential here to move all the way back down to 92 or so. But we are seeing this topping formation here, and it does look like that this support level will likely be broken to the downside. And our last bearish market observation for today is Walmart. So Walmart really reacted negatively to the news of this new variant. Obviously, they don't want anything to happen in terms of lockdowns. You don't want to see companies like Walmart. You don't want to see restrictions happening when you're Walmart, especially during the festive season, because that is such an important time for retailers, and especially names in consumer staples and discretionary space. So we can see here a bit of a double top here at 152. Price is showing some fairly bearish price action here. Strong decline to 140, 42 or so. A bit of a pullback, a bit of a retracement, a rejection of 148, and a strong move lower with strong bearish momentum. In terms of targets, I'd be looking at around 136 or so. That has provided a strong level of support in the last few months, but I do think the fundamentals and the technicals do point to further downside here in Walmart. So with that, that is all I have for you today. Thank you so much for joining me. I hope you gained some insight as to how we are viewing the markets, and I hope you gained some insight as to just what to prepare for in the case of a further pullback here in equities in the worst case scenario. That being said, it's not all doom and gloom. I don't think it will be nearly as bad as March and Feb 2020. That being said, it's always good to know, as investors, you always want to know what are the possible scenarios here and how it could affect your portfolio. So with that, thank you so much. I hope you have a great trading day, and I will see you next week.